Hello everyone, this is Bhavik Chokshi here and hope you guys are doing great. Today we would be discussing about financial instruments, one of the most important chapter of your CA final FR syllabus. We'll try to do a quick revision for financial instruments covering almost all the concepts which are relevant from an exam standpoint. At the same time, we would be kind of discussing key adjustments. Mind you, we will not be doing any sums over here. This is particularly relevant for November 22 and onwards. Students, there is also an old video which I have for financial instruments. However, that is around 2 or 3 years away, and a lot of students had requested us to put in a new video covering even the new adjustments and new topics. So here we go. The base that I've used is largely selected charts and tables from our FR Shield. You can refer that as well. Otherwise, even if you have referred any material, it's more of a revision video. I'm not going to run you through notes one by one. I'm just going to run you through the concepts. Okay, so let us get started. Financial instruments. Now, what is a financial instrument and which are the standards which cover it? So there is Ind AS 32, which deals with the definitions like financial asset, liability, equity. There is Ind AS 109, which largely deals with the accounting, classification, measurement, etc. And then there is Ind AS 107, which is the least important, which deals with, let us say, something like the disclosures. So largely, if you get a question in the exam, if it pertains to the definitions like financial asset, liability, equity, etc., that is Ind AS 32. Simply put it. For almost everything else, you have Ind AS 109. Now, what is a financial instrument? Well, financial instrument is something which creates a financial asset for one of the entities and a financial liability or equity for another entity. Now, what is a financial asset? Well, financial asset can be defined as cash, which is basically legal tender, can be in your own currency, can be some other currency. Equity instruments of some other entity. Your own equity instruments are not financial assets directly, that is your own equity. Equity instruments of another entity is a financial asset, and very importantly, any instrument which gives you a contractual right to receive cash or another financial asset. Now, this can be something like a debtor, something like a loan given, something like a debenture purchase, even a preference share purchase. In all of these cases, you have a contractual right to receive cash, and hence this is a very, very wide heading, covers a lot of aspects. Apart from that, you also have something where you have a contractual right to exchange financial assets or liabilities on potentially favorable terms, exchange on favorable terms. For example, you have an option contract where you are the option holder, where you have a right to potentially buy something at a favorable term. That is also a financial asset. What you study in financial asset almost exactly replicates in a financial liability, but on the opposite side. There is one more point in financial asset, but before going over there, in financial liabilities, you have a contractual obligation to deliver cash. When we look at this obligation, when will you have an obligation? Well, someone like creditors, you'll have an obligation to deliver cash or outstanding expenses or loans taken or debentures issued and even redeemable preference shares issued. In such cases, you have a contractual obligation to deliver cash, and hence it is a financial liability. It can also be a contractual obligation to deliver another financial asset. Apart from that, if you are exchanging financial instruments on a potentially unfavorable term, like you are an option writer, you are issuing instruments at potentially unfavorable terms, that is also a financial liability. Now, the last clause within financial liability as well as financial asset is for a special case where you might enter into a contract on potentially your own equity instruments. So, this is a contract where settlement will or may happen. Will, like a forward contract, or may, in case of an option contract, may happen, but in own equity instruments. Now, over here, what you have to broadly remember is if the settlement is happening for a fixed number of own equity instruments at a fixed price, it is by and large an equity. However, if there is any kind of variability in case of non-derivative instruments can be number, in case of derivative instruments can be number as well as in price. So if there is any kind of variability, it is considered to be financial liability if I am under an obligation to settle by issuing my own equity instruments, or it may be a financial asset if I have a right by receiving my own equity instruments. So this is what we loosely refer to as a fixed to fixed test. Now, a lot of times the students over here is bogged down by what is a derivative, what is non-derivative. A simple way to remember this would be, you should ask yourself that is there an exercise price, is there a cash consideration that is going to flow? If there is no cash consideration that is going to flow, then the price is irrelevant, then the number is only relevant. Like in every derivative contract, if you remember, you will have by and large an exercise price or an agreed price. If there is no agreed price or exercise price, then we can loosely interpret it to be like a non-derivative, like you are agreeing to buy a machinery, and in lieu of that machinery you are going to issue your own shares. If you are going to issue a variable number of your own shares, that is like a financial liability. The standard over here believes the recipient in this case is not bearing the risk till the time he actually receives the equity shares, so it is like a financial liability. On the other hand, if you are agreeing to issue a fixed number of own equity instruments, that means the recipient is actually bearing the risk. It is in the nature of equity. Well, yes, I have not received the not issued the shares, but the recipient is bearing the risk, and as a result equity. So if price is fixed as well as the number is fixed, it is in the nature of equity. If there is variability either in the price or in the number, it is a financial liability. And what is equity? Basically, equity is something which evidences what you call as residual interest. Whatever is left over, if that is what you are going to receive, if more is left over, you get more, if less is left over, you get less. That is the core feature of equity. Now, while I am defining equity, I have not said that equity means shares. So the standard does not focus on legal terminology, it focuses on the substance. We never use the words debentures, preference shares, equity shares anywhere. No, we said if I have a contractual obligation to deliver cash, it is a financial liability. Well, it may be a debenture, it may be a loan, it may be a preference share as well. However, if I have no contractual obligation to deliver cash, however, I have issued an instrument where there is a residual interest, whatever is left over, that is what I have to give, that is residual interest. This is what I call as equity. Typically, equity shares meet this definition, but other than that, even other instruments like irredeemable debentures with discretionary interest can also meet this definition. So it's a fairly wide term. So that broadly takes care of the definition of financial assets. There are a few examples you can kind of visualize, conceptualize the examples over here. Now a few things on what is not a financial asset, like income tax payable. Well, that is a statutory obligation to deliver cash and hence not a financial item. Product warranty or guarantee, here you have a contractual obligation but to repair. You don't have a contractual obligation to deliver cash and hence not a financial liability. Prepaid expense, well, you have a contractual right but to receive goods, but to receive services. It is not a contractual right to receive cash and hence not a financial asset. Unearned revenue, like if you pay fees in advance, we are under an obligation to give you services. We as such are not under an obligation to give you refund, let us say. So if you are under an obligation to give services, there is an obligation to give services, not an obligation to deliver cash, not, let us say, a financial liability. Advance for machinery, if we have received an advance, then we are under an obligation to deliver the machinery, not an obligation to give cash, so not a financial item. Physical assets like PPE, intangibles, etc., they give you future economic benefits, but they don't have a contractual right to receive cash and hence not a financial asset. They are assets, just that they are not financial assets. And then constructive obligations. These are obligations that arise due to past practices or published policies. Basically, they are not contractual obligations and hence we don't consider them to be financial instruments. So these are a few special cases. A very important thing that you have to remember here is about preference shares or debentures as a case. Maybe there are three essential features that you have to look at in order to segregate and determine whether the preference shares or debentures that an entity has issued is in the nature of financial liability or equity. So if I look at the distribution feature, if the distribution is mandatory, that is a financial liability feature. However, if the distribution is discretionary, that is an equity feature. After distribution, I also have to look at redemption. So if the instrument is irredeemable, that is perpetual, that is feature of an equity. But if the instrument is redeemable after a specified number of years, that is a feature of a liability. The last thing that we have to see is conversion. So is the conversion happening for a fixed number of own equity instruments or variable? If it is happening for a variable number of own equity instruments, it is a liability for sure. But if it is happening for fixed, you have to look at the features. So if it is happening for a fixed number of own equity instruments and it is compulsorily convertible, then it is in the nature of equity, at least a principal which is getting converted. However, if it is optionally convertible, where the option rests, let us say, with the holder, in which case you are under an obligation to deliver cash if the holder demands, and as a result there is a financial liability angle, but there is also an option given where the holder can convert into the issuer's own equity instruments, and hence there is an embedded equity option as well. So this is, if it's an optionally convertible instrument, it is financial liability with an embedded equity option. Now apart from that, there is commodity derivatives. Now usually derivatives can be currency derivatives, can be equity derivatives, can be bond derivatives. In all of these cases, whether the settlement happens in gross, that is by physical delivery, or net, that is by net differences in cash, it is considered to be a financial instrument. However, when we look at commodity derivatives, it is possible that the settlement of these items may happen physically, in which case we are having a contractual right to receive goods, physical commodities like sugarcane for example, in which case that is not a financial instrument because you have a contractual right to receive, let us say, a commodity. However, if net settlement happens, and net settlement is loosely referred to as settlement by differences in net prices, you are just paying cash for the difference in prices. If net settlement happens, then we can say that that is something where the settlement is going to happen in cash, so you might receive or pay cash. So if it is a commodity derivative which is gross settled, then we say that that is a commodity which you are probably using for your own use, and if you are using it for your own use, it is like covered under inventory or fixed assets, etc., where you record the inventory or fixed asset when you get the risks and rewards, ownership of the asset, not before that. You don't even have to pay cash, you don't even have to record the asset. When you receive the asset, yes, you record a payable, but before that, so if you have placed an order to receive commodities after 6 months, during those 6 months, you don't even have to recognize a payable because there is no obligation to pay till the time you receive the asset, and you don't even recognize the asset. Commodity derivatives which are gross settled, considered to be as a part of your own use, then something like own use exemption applies and we are out of the coverage of financial assets. We will record as per the respective standards. However, if it is net settled, in which case the settlement is going to happen in difference in prices by paying net cash, in which case you are covered under the financial instrument standard. You will typically follow the FVTPL accounting. This problem arises by and large for commodity derivatives. For other instruments like equity or currency or bond derivatives, even if a gross or a net settlement happens, you are going to receive either cash or another financial asset, and hence the financial instrument standards continues to apply. Okay, next on your screen you have settlement in own equity instrument. When we are looking at settlement in own equity instrument, we generally follow the fixed to fixed rule. That is, if the settlement happens for a fixed number of entities own equity instruments, and if there is a fixed price involved as well, then it is equity. In all other cases, it is a financial liability. Acha, usually these definitions strictly apply for classification. However, there is an exception which is available for what you call as puttable instruments and instruments of limited life entity. Puttable instruments are like open-ended mutual fund units where the holder can actually put the instrument and get cash. Now, ideally, in case of a mutual fund unit, we would say that this evidence is by and large the residual interest, and hence a mutual fund unit for the mutual fund is actually like unit capital or equity. However, since the mutual fund has a contractual obligation to deliver cash, it might fall within the definition of liability. Similarly, shares of a limited life entity like a joint venture, for example, which is formed for a limited period, you are under a contractual obligation to pay cash at the end of that specified period. Not a fixed cash, but at least cash. And hence, if I strictly apply the financial instruments standard, then these would directly go within the definition of financial liability. However, in substance, they represent equity features, and hence there is an exception where if 5 conditions are satisfied, that is, the instrument over here evidences a share, a pro rata share in the net assets. It is the most subordinate instrument in the course of liquidation. All the instruments in the most subordinate class have almost equal rights. There is no other guaranteed return except for the contractual obligation to deliver cash, and the cash flows that you get are the cash flows which are in the nature of performance cash flows of the entity. Then you can still classify these puttable instruments or shares of limited life entities as equity, even though there is a contractual obligation to deliver cash. Acha, proceeding further, you go to the second part of this standard, which is on classification. Now, classification can be for financial assets. There are three main classifications: amortized cost, FVOCI, FVTPL, or for financial liabilities, where there are two main classifications: amortized cost as well as FVTPL, and equity, where there is just a single classification. So when we are looking at financial assets, when will you show something at amortized cost? Well, in the language of the standard, if the business model is to collect contractual cash flows and the cash flows solely represent cash flows of principal and interest. When will it be FVOCI? When the business model is to collect contractual cash flows as well as cash flows from selling the asset, and the contractual cash flows are solely principal and interest. Apart from that, you also have a one-time irrevocable choice where you can show equity instruments of another entities at FVOCI, and lastly, everything else is going under FVTPL. This is the strict legal definition under Ind AS 109. Now, if I were to kind of state this in simplified words, contractual cash flows solely in the nature of principal and interest is loosely interpreted as a debt instrument. An instrument which is like a loan, a security deposit, a debenture, a debtor, bill receivable, all of these have contractual cash flows which are largely in the nature of principal and interest. Debtors, in the general market terms, you don't have interest, but you still have the principal. So here the cash flows are solely in the nature of principal and interest, but instruments like units of mutual funds, equity shares, derivatives, they don't give you just principal and interest, and hence the CCFC test, what you call as a contractual cash flows characteristic test, does not get satisfied for equity instruments, for derivatives, for mutual fund units, etc. By and large, it does get satisfied for debt instruments. So loosely we can say that debt instruments can be falling under amortized cost or FVOCI. But then how will you differentiate between FVOCI and amortized cost? Well, if you are holding it in the business model of only collecting, that means you don't have any intention to sell. That means you want to hold these debt instruments till maturity. That is when they will fall under amortized cost heading. Whereas if you are open to selling these instruments, if the opportunity arises, then you are holding them in the business model of collecting and selling, in which case FVOCI working will go. Everything that does not fall under amortized cost or FVOCI. So basically under amortized cost, you have debt instruments which you intend to hold till maturity. Under FVOCI, you have debt instruments which you intend to hold and sell before maturity. Everything else, which is a financial asset and which is not falling in the first two categories, will by default fall in the third category. Something like derivatives. A derivative financial asset will almost always go into FVTPL unless hedge accounting applies, or even held for trading items. Items which you are purchasing with the objective of selling it in the very near term will go under FVTPL, and items like equity shares, units of mutual funds will also go under FVTPL. Now there is one more thing about equity shares. Well, just for equity instruments of another entity, you have a choice. It's an unconditional irrevocable choice at the time of initial recognition, where you can classify this investment in equity shares into FVOCI instead of showing it under FVTPL. Also, there is another exception which is not as important, that if showing something as amortized cost or FVOCI will create an accounting inconsistency or an accounting mismatch, then you are allowed at the time of initial recognition to designate it at FVTPL. This is not very important in my opinion, but the equity option of showing it potentially at FVOCI is very important in my opinion. So these are the items which are kind of covered under FVOCI or FVTPL definition. So basically, if you want to classify something within amortized cost or under FVOCI, you have to apply two tests. One is something called a CCFC test or contractual cash flows characteristic test, or SPPI test, that is cash flows solely in the nature of payment of principal and interest. Now this test kind of says that what you are going to get should be solely in the nature of principal and interest. That is, the instrument should satisfy the requirements of what you call as a basic lending arrangement. And what do you expect in a basic lending arrangement? You expect compensation for time value like inflation. You expect compensation for, let us say, credit risk. Like if a company has a higher credit rating, you will charge more interest because you are bearing a higher credit risk, and a reasonable profit margin. So this is what you call as basic other charges like processing fees or prepayment penalties or extension charges. All of these are also in line with the basic lending arrangement. However, if you have something like a gold index bond, now in a gold index bond, you will get return indexed to the gold price. If gold price goes up, you'll get more. If gold price goes down, you're going to get less. Now, this is a bond, but it does not meet what a basic lender expects on the bond, and hence in such case the SPPI test or CCFC test is not satisfied. Well, if it is not satisfied, then the gold index bond or any such instrument which by default will now go into the FVTPL category only. But now if the test is satisfied, then you will further go ahead and do what you call as a business model test, where you will try to check for the business model, that is the way in which financial assets are managed. So if your thought process is a very passive thought process that okay, I will buy the bonds and I will forget about them, buy and hold, in which case you are holding them in the business model of collecting only, not that this is right or that is wrong. Or if your thought process is, well, I will buy, but if the opportunity arises, I'm open to selling it as well, in which case the business model is collecting and also selling. So that will go under the FVOCI classification. Now, while assessing for business model, you will not look at the worst outcomes. You will look at the average case. You will look at the entity's normal expectations and its objectives. Like if you are having investments for sinking fund, for replacing an asset, then you will see how long is the life of the asset, how long is the life of your investments, and then accordingly decide. You will see how the management is assessing the performance. Is it looking at the fair values? Is it looking at the interest while deciding the performance? If basically the objective is to sell, you will also check for the fair values. If the objective is not to sell, then you will by and large be checking for interest, credit risk, etc. So a lot of factors have to be considered, and it is a subjective assessment. Business model test, if it is only collecting, then it is amortized cost, collecting and selling, then it is FVOCI. Okay, that is about the classification, about financial assets. Then you go to the accounting. Now this is the heart of the standard. Now, how will you account for each of these instruments? Now, accounting meaning, how will you account it initially? How will you account it subsequently? How will the incomes be recorded? How will the expenses be recorded? How will the gains or losses be recorded? So, first of all, initial recognition. Now, historically, we always see that initial recognition is at cost. This is what changes here. The initial recognition over here is at fair value, not at cost. It is at fair value. So then what is the fair value? Well, usually if the transaction is happening at fair terms, at market terms, then the transaction price is the fair value. However, if there is some hidden element, like there is an employer-employee relationship because of which we have given loan at a concessional rate, or if there is a parent-subsidiary relationship because of which we have given loan at a lower rate, in which case there is a hidden element involved. And if there is a hidden element involved, in order to bring out the hidden element, we will record the transaction initially at what you call as the fair value. Now, how will you determine fair value? In most of the exam cases at least, fair value is calculated as a present value of future cash flows, where the discounting factor is the market rate of interest on similar instruments where you don't have any hidden benefit. So, if the employer did not have to lend to the employee but to some other party, or if the parent did not have to lend to subsidiary but some other party, at what rate would the parent have lent? That would be the discounting factor. Considering that, you will try to find the fair value. Initial recognition happens usually at fair value, whether it is accounted using amortized cost, FVOCI or FVTPL. Apart from that, there can also be transaction costs. Like for example, you might acquire shares, and as a part of that, you might have to pay some brokerage or STT or stamp duty. Will that also be a part of the initial recognition? The answer is yes for amortized costs, yes for FVOCI, but no for FVTPL. The standard says that, well, if it is FVTPL, that is fair value through profit and loss, ultimately everything is going to go to the profit and loss account. So rather than first recording the asset including the transaction cost, then comparing it with the fair value at each balance sheet date, taking the difference to P&L, you take the difference of the transaction cost to the P&L directly. This is for convenience in practice for FVTPL. So if you go to see, initial recognition is usually at fair value plus the transaction cost, but for FVTPL items, it is at fair value. Now at every subsequent balance sheet, in case of amortized cost, you will recognize the asset at amortized cost. How will you calculate amortized cost? Well, you will take the initial value, apply the effective interest rate, which is the IRR, the internal rate of return, and find what is the effective return that the instrument should give you. So if your fair value was, let us say 10,000 and the effective interest was 1,000, then ideally 10,000 plus 1,000 is the total receivable from the asset. However, I might have received something in the current year. For example, 900 I might have received in the form of coupon. and hence out of 10,000 plus 1,000, that is 11,900 has been recovered, and hence the amortized cost is 10,100. Maybe your ultimate redemption is going to happen at 11,000, so slowly you are proceeding towards redemption value. Now in this case the fair value is irrelevant because, well, items at amortized cost are intended to be held till maturity, and hence the fair value is usually irrelevant. However, when you go to FVOCI or FVTPL, these are held in the business model of collecting as well as selling or for trading, and hence fair value is relevant. And hence at each balance sheet date, you will show these assets at fair value. Mind you, this is historic, this is landmark, this is path breaking. It is not cost or fair value, whichever is lower. It's not cost or NRV, whichever is lower. It is fair value, which means even if it is higher or even if it is lower, we will take the fair value over here. So even if the bond you have acquired for 100, now it becomes 120, you will show it at 120. That is, you will increase the investment by 20. The second effect will go to the other comprehensive income as a reserve called as, let's say, a fair value reserve, if it is FVOCI, or it will go to the profit and loss account as a fair value gain, like you show foreign exchange gain in the profit and loss account if it appears as a part of FVTPL. Now within FVOCI, there are two types of instruments. There is something called as FVOCI equity instruments, and then there is something called as FVOCI debt instruments. FVOCI debt instruments, this OCI is what is a reclassifiable OCI, which means on happening of certain events like a sale, the balance in the OCI will be transferred, like the fair value reserve will be transferred to the statement of profit and loss, other income, reclassifiable. However, if it is FVOCI equity, then on happening of certain events like a sale, the balance in the fair value reserve as a part of OCI will be transferred but directly to the retained earnings. इसको अपन बोलते हैं non-reclassifiable OCI. So remember, FVOCI debt instruments reclassifiable, that means on sale the balance in the fair value reserve goes to the profit and loss, whereas FVOCI equity non-reclassifiable, which means on the sale of such equity instruments the balance in the fair value reserve will directly go to the retained earnings. Now how will you recognize income in each of the years? Like in amortized cost as well as in FVOCI, you will recognize income using effective interest method, and the effective interest over here is usually the IRR, the internal rate of return. Now, when will the IRR be different from the coupon rate? Well, usually the IRR is different if there is any processing fees or transaction cost, if there is any discount or premium on issue or discount on premium on redemption. So basically, if there is no discount or premium on issue or redemption, there are no transaction cost or processing fees, then your real return is just the coupon. Then coupon is the same as the EIR. But in case there is any difference, then the coupon and EIR can be different. In case of equity shares, you will receive dividend, and this dividend will also go to the profit and loss account. Effective interest will also go to the profit and loss account. Sir, but if it is FVOCI, it is FVOCI, that is fair value through OCI, not income through OCI. So dividend is an income which will still go to the profit and loss. Fair value gains will go through the other comprehensive income, not all incomes. And lastly, if there is any realized gain or loss, then the realized gain or loss will go to the profit and loss usually in FVTPL or in rare cases in amortized cost. But in FVOCI instruments, if it is FVOCI debt, the realized gains will be going to the profit and loss from the OCI. If it is FVOCI equity, the realized gains will go directly to the retained earnings. So this is your core accounting. In rare cases where fair value is not determinable, the standard allows you to show at cost. However, that is if fair value is not determinable. The application of effective interest is something which is very important for you from an exam standpoint. So when you look at the effective interest method, effective interest will be based on the opening balance into the effective rate. That will be your real income. That will be added to the opening balance. Then if I have to calculate the closing balance, that is the amortized cost, I'll take the opening balance plus the effective interest less coupon or principal received during the year, and that will give me my closing balance. Usually if my effective interest method is correctly depicted, then I go towards the redemption value. If it is a redemption happening in single shot, then I'll go towards the redemption value at the end. If my redemption is happening in each year, amortizing in each year, 1/5 being repaid in each year, then ultimately my balance will go down towards zero. So this is effective interest. Initial recognition, as we said, should be at fair value. If nothing is given, the transaction is at market terms. If it is at market terms, the transaction price is the fair value. A lot of times students are unable to determine whether the transaction is at fair value or not. Well, if nothing is given, remember the transaction is at fair value. However, if you have been given data like it's a parent and subsidiary, market rate of similar transactions would have been so and so, it's a landlord and a tenant, market rate on similar transactions would have been so and so, employer-employee market rate on similar transactions would be so and so, that is when you sense that it is off market. Otherwise, it is not off market. Merely because coupon rate is different from the effective rate, it is not off market. Like in the zero coupon bond, coupon is zero, but there is an effective rate. That does not mean it is off market. It is at market terms only. However, if ideally the discount should have been 40 rupees, the discount is only 10 rupees because it is parent subsidiary. That is what is off market. If you are unable to figure out, then you try to find the present value of the future cash flows. You will get, if it is at market, the fair value to be equal to the transaction price. If it is off market, the fair value to be different. Now, if the fair value is different, where should the difference be going? Well, it depends on the type of the transaction. Like for employer-employee, the difference goes to staff welfare, employee benefit expense. For landlord-tenant, the difference goes to right of use, ROU asset, that is for prepaid lease payments. For parent to subsidiary, the difference usually goes to the investment. For subsidiary to the parent, the difference usually goes to the dividend or distribution. In the books of the subsidiary, if the parent has made an investment, subsidiary has received that investment, that is called as capital contribution. In the books of the parent, if subsidiary has given the dividend and parent has received the dividend, that is called as dividend income. Now, these are the standard adjustments which usually come. An application for this also comes within Ind AS 20, the government grant standard, but on the financial liabilities side. So, if the government gives a loan to the entity, so if the entity receives the loan, the accounting process is still the same. You initially have to record the loan at fair value. But if the government gives a loan at a 0% interest, then the entity will recognize a hidden grant under Ind AS 20, and the accounting for that will be as per Ind AS 20, the standard on government grants. Acha, there is a fairly important question which has come twice in the exam, where there is loan at off market transaction like an employer-employee, and then there is a part payment, prepayment, which is done by the employee slightly early. So if there is a part prepayment that is done, then on the date of prepayment, what do we have to do? We have to find the carrying value currently, but you have to record for the prepayment, in which case after the prepayment you will try to find that what should be my revised carrying value. My revised carrying value will be the present value of the remaining cash flows after considering the prepayment. So if my current carrying value of the loan, let us say, is 6 lakhs, I am prepaying a specified amount and the revised carrying value is coming down to now 4 lakh 50, considering the remaining payments that I have to make. That means my loan has to go down from 6 lakhs to 4 lakh 50, that is 1 lakh 50. However, if I have prepaid, let us say 1 lakh 80, then what is the difference attributable? Well, the difference is attributable to hidden employee benefit, which is no longer going to happen. You thought that I am going to give a benefit in the form of concessional interest over a period of 5 years to the employee. However, the employee is prepaid in one of the years, and hence the benefit will be available for a lesser tenure, and hence the balancing figure, if any, on that prepayment will go towards hidden employee benefits. So that is something which you have to do. We have also uploaded a separate video for this part only, along with a full-fledged sum. So you can just search for loan at off-market terms with the part prepayment. Please do that. Students who do trend analysis had actually seen this question in one of the papers and said, yaar abhi to ye wapas nahi aayega, ek baar aa gaya. The very next paper, the same question came up. So please, the idea is don't do a lot of trend analysis. Try to focus on everything which is important and everything which is relevant, and you will really score really good marks. So that was about part prepayment. Then you go to financial liabilities. Well, the classification of financial liabilities is a lot more easier as compared to financial assets. By and large, there are two main classifications. There is financial liabilities at FVTPL. There are 6 specific items like derivative financial liabilities, held for trading items like if you have short sold something, or financial liabilities shown in order to prevent or rectify an accounting mismatch will come over here. Then you have contingent consideration as a part of business combination. You have financial guarantees, and you have liabilities which are shown under the continuing involvement approach will go under the FVTPL. Everything else under the sun will go under amortized cost. So something like creditors, something like loans, something like debentures, everything will go under amortized cost working. Now, the accounting for financial liability is similar to that of financial assets. If it is amortized cost, initial recognition is at fair value, but here you subtract the transaction cost, not add. Financial assets have a debit balance, transaction cost also has a debit balance, you add it. But financial liabilities have a credit balance, transaction cost still has a debit balance, and hence you will have to subtract it. If it is FVTPL financial liability, then the transaction cost will still go to the profit and loss account. For subsequent recording and subsequent working in amortized cost, you will record it at amortized cost using the effective interest method. In FVTPL, you will show it at fair value. The amount that goes in the P&L will be the effective interest. In case of amortized cost, will be whatever is the coupon interest, let us say, in case of FVTPL. And interest and dividend, if any, will be going to the profit and loss account directly. There are a few special cases like loans repayable on demand, like for example, if I'm a bank and if I've accepted current account, so in case of current account, whatever I get is, in case of current account, whatever I get, I don't usually have to pay interest, and as a result, Institute has given a guidance that if it is a loan repayable on demand, honestly, the borrower does not really get to use the funds usually in the manner they desired. They have to keep the funds ready for repayment whenever the lender demands, and hence the fair value will equal the transaction price. In certain cases, the loan is not repayable on demand, but it is not repayable on a fixed date. It is repayable on completion of a particular project. In such cases, you will have to estimate that when is it likely that the project will be completed, and accordingly you determine the fair value and the tenure for this loan. A few common transactions, as we have discussed, at off-market rates are appearing on your screen. You can just refer that as well. And lastly, coming to equity. Now, there's a very well accepted principle in accounts that own equity cannot be remeasured. And as a result, there are no separate classification and separate fair value principles for the purpose of equity. You will record it at the fair value as determined on initial recognition. You will not keep on remeasuring it. The transaction cost summary for all that we have studied over here is typically for financial assets at amortized cost or at FVOCI, you add the transaction cost. If it is FVTPL, you take the transaction cost to the P&L. If it is financial liability, then you will deduct the transaction cost. However, if it is that is at amortized cost, if it is financial liability at FVTPL, again the transaction cost goes to the P&L. If it is equity and you are issuing fresh equity, then whatever is the transaction cost will be reduced from the equity. However, if it is issue of already existing shares, like it's a follow-on offer, in which case whatever is the transaction cost can go to the profit and loss account in case of equity. Reclassification, well, reclassification is not possible for equity because there's a single classification. It is not permitted for a financial liability, and for financial asset, reclassification is considered to be extremely rare and can be done only if there's a change in the business model, which is extremely rare. So, if there is a reclassification, then how will the reclassification happen? Well, in case of reclassification, you can move from amortized cost to either FVTPL or FVOCI, in which case gains or losses, if any, if it is moving to FVTPL, will go to the profit and loss. If it is moving to FVOCI, will go to the OCI. If you are moving from FVTPL to, let us say, amortized cost or to FVOCI, then till the date of reclassification you are FVTPL, and as a result whatever is a gain or loss up to that date will still go to the profit and loss account. And lastly, if you are moving out of FVOCI and then going either to amortized cost or going to FVTPL, then how will the working be? Well, if you are moving out of amortized cost, then there will be some fair value reserve. What are you going to do with the fair value reserve as a part of OCI? Well, if you are moving from FVOCI to amortized cost, then the balance in the fair value reserve is adjusted against the carrying value of the asset. So, the asset will be appearing at whatever is the carrying value plus or minus the fair value adjustment. And if it is going into the FVTPL, then you will continue to show the asset at fair value. However, the balance in the fair value reserve will now be transferred, let us say, to the profit and loss account. Well, because reclassification can only happen in case of debt instruments, equity instruments, one classified as FVOCI cannot be reclassified in the future. Okay, now there is also special guidance on something called as regular way contracts. Regular way contracts are contracts which in the regular way settle after a specified number of days, weeks or months in line with market convention or legal stipulation. Like for example, when you settle the contracts on BSE, typically they settle after T+1 or T+2 days, as the case may be. Earlier it was as high as even 30 days. Now this is the settlement period which is governed by the exchange. It is not something that you and I can decide, and hence these are called as regular way contracts. And in case of regular way contracts, the standard allows you to not treat it as a derivative contract. It is just a spot purchase, just that the settlement is happening after a few days based on not a mutual agreement but based on a market stipulation, and hence it is a contract in a regular way settled at a future date, not a derivative contract, in which case you can either have an option of trade debt accounting, which is the usual accounting where you recognize a purchase when you do the trade, when you recognize a sale when you do the trade, or you can do a settlement date accounting, that is you recognize a purchase when the share gets settled, that is comes into your demat account, or recognize a sale when the share moves out, let us say, of your demat account. So this is only for regular way contracts that this option is available. Okay, next we move on to compound financial instruments. This is an important section, very important, almost comes in almost every exam. So what is a compound financial instrument? It is an instrument which has both liability as well as equity features, in which case should you record it as a liability or equity? Well, the standard says if it has multiple features, then you should actually split and record it depending on the features that it has. So over here there is split accounting which is required. How will you do the split accounting? Well, you might have received some issue proceeds. The standard says you will have to split the issue proceeds into the liability component of a convertible debenture or an equity component of a convertible debenture. So for example, if I have received let us say 10,000 rupees today for a 7% convertible debenture, which is going to pay coupon at the rate 7% for a period of 5 years, and then it can get converted in case of optionally, or it will get converted in case of compulsorily. In which case, what will you do? You will have to first find a liability component, saying that if this was a pure liability, that is there was no conversion feature, do I still have a contractual obligation to deliver cash? Yes. For the coupons, yes. For the principal, well, it depends. If it is compulsory conversion, I don't have an obligation to deliver cash, and hence I will not consider the principal in the liability component for compulsorily convertible instruments. But for optionally convertible instruments, I have an obligation to deliver cash if the holder demands or if the issuer has to pay, in which case I will include them in the assessment of the liability component. These cash flows will be discounted at the market rate of interest on similar non-convertible instruments. So if someone had come to me saying that this was a non-convertible instrument, then how much would be the amount? So I'll take the market rate of interest on similar non-convertible debentures, find the liability component, which is easier to find. Whatever is the remaining amount, so let us say the liability component comes to 8,500. I have received 10,000. Ideally, if someone came to me with similar terms, but without the conversion option, I would have paid 8,500. Then why am I paying the remaining 1,500? Well, probably the investor is paying that because you are giving the equity option. Now, this equity option, if it is an option, may settle for a fixed number of entities' own equity instruments at a fixed price, and hence the option is considered to be in the nature of equity. And hence this is treated as the equity component. So what will happen to the liability component? Well, the liability component will be recorded using the amortized cost method, whereas the equity component will not be restated. Whatever is a 1,500 will continue as it is. Now, in each of the years, you will recognize effective interest, that is 8,500 into the market rate of interest on similar instruments. That will be the effective interest. That will go to the P&L. So interest expense account debit to liability component, and you will be paying something, maybe the coupon. Your entry will be liability component account debit to bank for the coupon. That way, you will keep on finding the amortized cost in each year. If it is an optionally convertible instrument, the amortized cost will slowly proceed towards the potentially redemption value. Whereas if it is compulsorily convertible instrument, the amortized cost will proceed slowly towards zero. At the end, when you are actually doing the conversion or doing the repayment, if it is compulsorily convertible instrument, there would be no liability component remaining, in which case your entry will be the equity component account debit to equity share capital to securities premium for compulsorily convertible instrument. For an optionally convertible instrument, your entry will be liability component account debit to bank if the holder exercises the redemption feature. Equity component balance will be transferred to the retained earnings because it is an owner to owner transaction. On the other hand, if you take the liability component as conversion, then your entry will be liability component account debit, equity component account debit to equity share capital to securities premium. The consideration for the shares issued is basically the liability foregone, and hence liability component will be debited as a part of the share issue entry. Now, a classic problem that students keep on facing is whether a particular instrument given in the question is compulsorily convertible or optionally convertible. Well, usually if nothing at all is given in the question, then we will assume that if there is no option given, that means the conversion is compulsory, no one has a choice, then it is compulsory conversion. However, in certain cases where in the question you have somewhere been told that the holder exercises the conversion option, or in the question you have somewhere been told that there is an early redemption. Remember, holder can exercise the conversion option, or the holder can exercise the redemption option if there was redemption option in the first place. If there was no redemption option, then holder cannot exercise that option. If there's an early conversion or an early redemption happening, an early redemption can happen if there's a redemption feature in the first place. If there is no redemption feature, there cannot be an early redemption. And as a result, in certain cases, in line with the institute solutions to maintain consistency by and large, we will take those as optionally convertible. But if nothing is given, no early redemption, no early conversion, nothing given where there is an option given to the holder, then we assume that it is compulsorily convertible. Okay, now what happens in case there is a transaction cost in a compound financial instrument? Remember, the transaction cost is also attributable both towards the liability as well as the equity component. So you will allocate the transaction cost in the ratio of the carrying value of the liability as well as the equity component. Had there been no separate transaction cost, we will try to find the carrying value and then allocate the transaction cost in that ratio. Next, if there is an early redemption, well, if an early redemption happens, usually an optionally convertible instrument can be early redeemed. A compulsory convertible instrument cannot be early redeemed because there is no redemption possibility. So if there is an early redemption for an optionally convertible instrument, you will debit the liability component, you will also debit the equity component, and you will pay the redemption price. Now the problem is, in this case, a balancing figure, where will you take? Well, if it is for the liability component, it has to go to the P&L, because it is a settlement of a liability. But if it is for the equity component, then it should go to the retained earnings. And hence you will also have to do split accounting for the redemption price, the early redemption price. So while you are doing the split accounting for the early redemption price, you will try to find the present value of the remaining cash flows at the market rate of interest on the date of early redemption. That will give you how much you are paying for the liability component. Whatever is the remaining amount, you are paying for the equity component. Once you are able to segregate and find the amount for the liability and the equity component, you will pass two separate entries. Your liability component as per your books account debit to bank based on how much you are paying for the liability component. Balancing figure goes to the P&L. In the equity component, you will debit the equity component in your books, which will be the same value, to bank, and the balancing figure will be taken against the retained earnings. Next, we go to the callable and puttable features. Now, this is something which is very special, very rare in terms of exam standpoint. So, what is a callable feature? A callable feature is a feature where the issuer has a right to redeem the bond earlier if the issuer wants. Now, such a feature is adverse to the holder because the issuer will typically call for the bond when the issuer sees that the issuer is at an advantage. On the other hand, there can be a puttable feature where the holder can put the bond and force the issuer to give the money back, which is favorable to the holder. Now, in case there is a callable feature, it is treated as adverse to the holder, and as a result, if there is a separate fair value attributable to the callable feature, we will deduct it from the liability component because it is going to settle in cash. If it is a puttable feature, it is favorable to the holder, and hence we will add it to the fair value of the liability component if a separate fair value of the puttable feature is given. Remember, you have to do these adjustments if and only if the fair value of the puttable or callable feature is separately given to you in the question, otherwise you don't have to do this. Lastly, if there are floating rate instruments, in case of compound financial instruments, you will be given the market rate of interest on similar instruments which are also floating. So, if I have to find the liability or equity component today, you will first try to find the value of the liability component considering the market rate, like the RBI rate or the LIBOR rate prevailing as on the date of issue. And the market rate of interest will also be, let us say, LIBOR plus say 4%, the market rate, LIBOR plus 1%, let us say the coupon rate. So both of these will be in floating rate form only. Okay, so this takes care of the compound financial instruments, and largely the most important part of the standard kind of till now. Derivatives, which are kind of slightly important, and the remaining part of the standard is relatively lesser important when it comes to an exam standpoint. What is a derivative? Well, derivative is something which derives value. It does not have its own value. So a forward contract, option contract, futures contract, etc., they derive value from an underlying. The underlying can be a currency, can be a share, can be a bond, can be anything. Second, the settlement for a derivative happens at a future date. It does not spot settle, it happens at a future date. And lastly, the amount to be paid initially is either nil or insignificant, as the case may be. If all the three features are met, then a particular item is considered to be a derivative. Now, if it is a derivative, how will the accounting happen? Well, if it is a derivative financial asset, that is, it is giving benefits, in which case we will account for it using FVTPL, fair value through profit and loss, unless hedge accounting applies. If it is a derivative financial liability, still we will account it using FVTPL. However, if it is a derivative equity instrument, like if it is settled in own equity instruments or a fixed number of own shares, in which case you will recognize it at the fair value at initial recognition, and then there will be no subsequent remeasurement. Like the equity component in case of a convertible debenture, you do not subsequently remeasure, and it will continue to appear at the fair value at initial recognition only. Now, going further into the embedded derivatives. Embedded derivatives refer to derivatives which are stitched into, embedded into a host contract. Now, what should I do? Like, if I have a watch and it is diamond studded watch, then diamonds are embedded inside that watch. I understand it is not a derivative, it is not a financial asset, but just to give you perspective. So, should I show the diamond separately and the watch separately, or should I show it together? That is what the standard gives you guidance. The standard says that if your host contract, like if I take the example of a convertible bond, the host contract over here is a bond, a non-convertible, a simple plain vanilla bond. If it is a host contract is a bond, if the host contract is a financial asset, so if you have invested in a bond, convertible bond, then the host contract is a financial asset, and if the host contract is a financial asset, the standard says separation principles do not apply. You will have to record the entire financial asset, that is convertible bond, usually let us say at FVTPL principles. However, if the host contract is either a financial liability, that is if you have issued a bond, then the host contract is a financial liability, bond issued. Or if the host contract is an equity instrument like equity shares, or if it is a non-financial item like a sale or a purchase agreement, then the standard says that the separation will have to be done if the economic characteristics of the host contract, let's say the debenture, is not closely related. That is, it is different from the embedded derivative. Like the option to convert, the economic characteristics are driven by the share price of the entity, the performance of the entity, whereas the bond is driven by the market rate of interest. They are not closely related, and as a result you separate the equity component and the liability component. At this stage a lot of students get confused. Sir, is embedded derivative and compound financial instrument different? Are they one and the same? The answer is yes. Compound financial instrument is one of the example of embedded derivatives. It is not different, it is just one of the examples for embedded derivatives. Secondly, the derivative meets the definition of derivative, and you have not designated the entire contract as FVTPL for rectifying an accounting mismatch. If all of these features are met, then you will do separation. That is, you will show the liability component and the embedded derivative separately. While doing this separation, the standard says that you should try to find the fair value of one of the two pieces, whichever is more easily determinable. Like in case of a convertible debenture, the liability component is more easily determinable, and the other component has to be found as a balancing figure. You don't sit and apply valuation techniques for both of them. You try to value one of them and the other will be taken as a balancing figure. Okay, this is about separation principles. Now, Institute has given two special cases for the embedded derivatives. First is if I am a borrower and if there is a prepayment option. Is there an embedded derivative, and if there is there a separation required? Now, separation is required if the host contract, that is a loan, and the embedded derivative, that is a prepayment option, an option to prepay, it is also a derivative because it derives value from the market interest rates. If the market interest rates increase, the prepayment option becomes more valuable. If market interest rates fall, let's say in case of a floating rate loan, it becomes less valuable. Or if it's a fixed rate loan, then if the market rate of interest is falling, then it is a lot more advantageous to prepay because I can prepay and take the loan at a lower rate. If the market rate of interest is rising, it is less advantageous to prepay. So basically that option can derive value and hence it is a derivative. Should I do separation or not? Well, the standard gives you specific steps. You will first try to find the fair value, that is the present value of future cash flows had there been no prepayment option. Then you will prepare an amortized cost table considering no prepayment option. Once that amortized cost table is prepared, at each prepayment date, you will compare the amortized cost with the prepayment amount. Now, if both of them are approximately equal, the standard believes that the prepayment amount is determined considering the underlying loan, and hence they are closely related, no separation is required. However, if even on one of the dates, the amounts are not closely related, that is, they are not approximately equal, then the standard believes that they are not closely related and hence a separation will have to be done. Now, approximately equal hai ya nahi hai, that threshold has not been defined. The one problem that is there in the institute study material, the threshold is defined to be 2%. So if it is beyond 2%, we consider that they are not approximately equal. If it is within 2%, we consider that they are approximately equal. If they are approximately equal, no separation done, bank account debit to loan, and you will record the entries in the usual manner. However, if separation is to be done, then bank account debit will be what you have received as a loan, let's say 100, to loan. This will be loan had there been no prepayment option, for example 104.23. Then the remaining amount, that is 4.23, is like the derivative financial asset attributable to the prepayment option. So your entry will be bank account debit 100, let us say prepayment option account or a derivative financial asset account debit 4.23 to, let us say, loan 104.23, if a separation is to be done. The second case is if there is foreign currency embedded in a foreign currency purchase or sale contract. Now again, this is something where a lot of students get confused, especially after studying their SFM. We have put a separate video entirely on this section saying embedded derivatives. For this, you can search that if you have, if you want to have a detailed understanding for that. Now this is a transaction where you have probably agreed into a contract, let us say, to sell goods to a foreigner. Now the standard says ideally, if I am selling goods, I should get the same value for my goods, whether I sell it to an Indian person or a foreign person. The goods, if they are worth 50,000, they should give me 50,000. However, if I sell it to a foreigner, I might sell it at $1,000, which might become 55,000 or which might become 45,000. So the extra 5 or the less 5 that I am getting is not for the goods but because of the exchange. And as a result, there is a foreign currency element which is embedded inside a regular host sale contract. So what do I do? Typically in such cases, I will diagrammatically represent the transaction where if it's a sale contract, I would have entity A Limited selling goods, one side of the transaction, and receiving $1,000, other side of the transaction. Now these two legs I will separate into two separate transactions. That is the first leg, I would show sell of goods, and against that an expected receipt in my local currency, that is rupees, which I will take usually at the forward rate. The second leg of the transaction is I'm receiving dollars, but if I receive dollar in an independent forward contract, I will have to pay rupees. Again, that will be at the forward rate. Now these two separate transactions that I've diagrammatically represented have to be accounted for, journalized separately. So the sale contract in rupees will be as per Ind AS 115 revenue recognition, and there will be no entries till the time the actual physical sale happens, that is the control of the goods is transferred. At the time of control of goods being transferred, you will pass the entry at the originally determined forward rate. Secondly, for the independent forward purchase contract, here students kind of believe that it's a forward sale because it's an exporter, I will receive the goods. To hedge, I will sell the dollars. I'm not hedging, remember, I'm just splitting the original transaction, and hence I'm saying that, okay, if I'm exporting goods, I'm going to receive dollars, that is equivalent to buying dollars. In which case, I will record this transaction using fair value through profit and loss account. It's like a derivative purchase, fair value through profit and loss account. There will be no entry at initial recognition. There will be no entry even during the subsequent period. And then ultimately, whenever the fair value changes, you will have to pass the entry. So if subsequent period the fair value changes due to the exchange rate change, then entries will have to be passed. At the last date, when the settlement happens, you will settle the derivative financial asset against the debtor, or if money is received, against the bank. Now it's very difficult to just kind of compress this, so I mean, I would recommend, if you are not very clear, refer the slightly more detailed video on this. But this is something that you don't usually do. So when is this done? Well, this is done if the embedded derivative and the host contract are not closely related. But typically the foreign exchange and the sale are closely related. So the standard says, when are they not closely related? Well, they're not closely related when the contract is not priced in the currencies of one of the parties to the contract. So if I'm an Indian party, the other party is US, and the contract is, let us say, priced in yen, in which case we can say it is not closely related. Secondly, it should not be in the currency which is usually used to price these goods. Like oil is usually priced in dollars. So over here, if I might be an Indian company and I might be buying oil from a Saudi Arabian company, and if the transaction is priced in dollars, I would still say they are closely related, because oil is denominated in dollars. You will find hundreds of articles on the net which show a relationship between the dollar and the oil price. And lastly, the transaction is not priced in the currency of the primary economic environment in which an entity operates. So for example, if I'm a Swiss company, my currency is the Swiss franc. However, euro is also accepted. So I might be doing a transaction with a Swiss company in euros. It is still in a currency which is accepted in the primary economic environment in one of the parties. So if my contract is not in the currencies of the parties, it is not in the currency in which the commodity is usually priced, it is not a currency which is used in the usual primary economic environment of the entity, then we will do this separation. In all other cases, no such separation is done. Your regular principles of Ind AS 21 foreign exchange and Ind AS 115 revenue recognition will apply. You will recognize the transaction directly at the spot rate on the date of transaction if no separation had to be done. So this is a fairly complex case. Next, you move on to the derecognition of financial assets. So when we derecognize financial assets, what are the important points to remember? First, we derecognize typically when we sell the financial asset, or essentially we give up control of the financial asset. When is control set to be given up? When the risks and rewards of the financial asset are no longer with us. Now, typically we assume that the control is given up at the time of sale. Usually, yes, it is given up at the time of sale, but that is not the only scenario. Even other than sale, there can be circumstances where you might be giving up control, where you have to do some derecognition, or there might be circumstances where you were traditionally thinking that control is not lost, or sale is kind of probably made, where you might not have to do derecognition. So over here, derecognition happens when control of the goods or control of the financial asset is actually transferred. We will discuss a few special cases over here, starting with bill discounting. Traditionally, we have always thought that when bills are to be discounted, you will debit the bank, credit the bills receivable, and also show the discount charges, etc. However, when you are crediting the bills receivable, you are derecognizing them. Now, as a matter of fact, if these bills get dishonored, the banker is going to come back to you and recover the money. And as a result, the risk of the bills is not going out of your books, and as a result, it is inappropriate to derecognize them. And hence, as per Ind AS 109, by mere discounting of bills, we will not derecognize it. So, when will we derecognize it? Well, when the bills are actually honored. When the bills will recover money, that is when you will derecognize it, not on merely discounting. Then how will we account for the discounting? Well, it is treated as if it is a loan transaction. You will pass into a bank account debit to, let us say, loan. Bills will continue to appear. Then loan will be recorded using effective interest. Loan will be recorded. Interest will be recorded. At the end, if the bills are honored, in which case the entry will be bank will directly collect the money. So bank account debit. You will have, let us say, money will be directly collected by the bank. So it will be loan account debit to, let us say, the bills receivable. This is the time when you can derecognize it. If bills are dishonored, that is when the bank will recover money from you. So the entry will be loan account debit to bank, and bills will continue to appear. You will create a provision for bad debts if you think that the bills are not recoverable. Similar logic also applies for factoring. There are two types of factoring. One is recourse factoring, that is the factor has recourse back to you, and the other is non-recourse factoring, where the factor bears the risk of the bad debts as well. If it is recourse factoring, the standard still believes that it is like a loan transaction with merely security of the factor being taken, security of the debtors being taken. On the other hand, if it is a non-recourse factoring, it is a genuine sale transaction, in which case you will recognize a gain or loss on the derecognition of trade receivables. In case of a recourse factoring, you will do the accounting similar to that of bills discounted. It is a loan transaction. Then there is sale and repurchase. If there is a sale and repurchase, if the repurchase is agreed to be made at a fixed price or after adding a fixed rate of interest, then the standard believes that the risk and reward of the security is transferred are not really being transferred to the buyer. And as a result, this is also treated as if it is a loan transaction. So if there are securities which are sold at 100 and agreed to be repurchased back at 110, then 10 rupees is treated to be the interest, 100 rupees is treated to be the loan. There is no sale recorded, there is no purchase also recorded. It is treated as a loan transaction. However, if the sale happens and the repurchase is agreed to be done at the fair value, in which case we now agree that the risk and reward in the intermediate period is actually transferred to the buyer, and as a result we will have to, in such cases, recognize the sale and then a separate purchase. If the repurchase happens at fair value, if the repurchase happens at the fixed price, there will be no derecognition. It is treated as a loan transaction. An improvisation over this case is the sale with the repurchase option. Now, if there is a repurchase option, the problem is the option may be exercised, the option may not be exercised. So unless we are absolutely certain that the option will be exercised, we will treat it as per its legal form, that is, we will record it as a sale, and if the option is recognized, then recognize it as a purchase. However, if the option is deeply in the money meaning a very high probability that the exercise will happen, in which case if the option is exercised, then the security will come back to you. If it is highly likely that this is going to happen, then you can still recognize it as a loan and a repayment of loan transaction instead of recognizing a sale. The next case is that of a securitization. That is, if let us say you are acquiring loans or some fixed return assets, and in lieu of that issuing participatory notes or pass-through certificates. So this is a securitization transaction. In this securitization transaction, whatever cash we collect from the loans is going to be passed on to the holders of these pass-through securities. In such a case, we are really not having any control over the loan. So if you collect more, you are going to pass on more. If you are going to collect less, you are going to pass on less. And as a result, it will be appropriate to derecognize the loan in our books. I might have the rights to collect money on the loan, but I don't have the rights to retain the money. I have to pass it on without any material delay, in which case the standard believes that you should derecognize the loan in case you have done a securitization transaction, provided you are under an obligation to pass through whatever you have collected. Nothing more, nothing less. So there is no guarantee. You are under an obligation to pass it through without any material delay, and you do not have any rights to sell, pledge or transfer the loan without the express consent of the certificate holders. In such a case, you will recognize the sale, that is, you will derecognize the loan from your books. Then there is something called as continuing involvement approach, in which case what happens is you are having debtors and you are transferring the debtors to a factor, let us say on a non-recourse basis. However, along with that transfer, you are also giving guarantee for a part of the debtors, in which case on one hand you are transferring the debtors, but on the other hand you are going to be continuing to be involved with the debtors to the extent of the guarantee. What do you do in such case? Well, you will derecognize the debtors to the extent of the carrying value and continue to recognize the debtors to the extent of the amount of guarantee or the carrying value of debtors, whichever is lower. But if you recognize the debtors, then at the same time you are under an obligation for the guarantee, and as a result you will create an associate guarantee liability. Now this associated guarantee liability will be typically equal to the amount of the guarantee given. However, usually along with guarantee there is also a guarantee commission, and hence there can be a fair value of the guarantee given. So the ICI says that you should recognize the associate guarantee liability at the guarantee amount plus the fair value of the guarantee commission if available. If the guarantee commission fair value is not given, you can ignore the same. You can even recognize the fair value of the guarantee commission as a separate line item, as a separate liability, though institute recognize it as a single liability. The balancing figure, if any, that arises on this transaction will be considered as the gain or loss on the derecognition of these debtors. Also, the associated guarantee liability, at least the fair value which is linked to the guarantee commission, will be recognized as income over the tenure of the guarantee. Next, we have partial derecognition of financial assets. Sometimes it might happen that there is a bond and you are transferring just the interest component of the bond, or it is the principal component of the bond, in which case you will have to compare the sale proceeds that you have received on such transfer with the proportionate carrying value. The proportion of the part that is transferred is calculated based on the proportion of the fair value. So you will compare the fair value of the entire bond, compare it with the fair value of the part that is transferred, and in that ratio you will split the carrying value as well. So that will give you the proportionate fair value of the part transferred. And accordingly, you can recognize the gain or loss. Next, we move on to the derecognition of financial liabilities. Typically, financial liabilities are derecognized once you discharge them, that is, they are either paid or they are kind of waived off. Now, there are two special cases, one is debt for equity swaps and one is modification. We will first discuss about modification, which is more important. So, sometimes what might happen is you might enter into renegotiation for the loan transaction. So, when we are doing the renegotiation can result in the changes which are substantial or changes which are not substantial. Now, if the changes are substantial, then extinguishment accounting applies. If the changes are not substantial, then a modification accounting applies. Now, how will you figure out whether the changes are substantial or not? Well, the standard over here says that you will compare the present value of the modified cash flows at the existing EIR, the old EIR, with the carrying value. Carrying value is nothing but the present value of the existing cash flows at the existing EIR. So, you will take the difference between the two. If there is a modification, they should differ. Modification is of cash flows, then they should differ. You will take the difference. The difference is the present value of the modified cash flows at the existing EIR minus the current carrying value divided by the current carrying value. If this gap is more than 10%, either positive or negative, does not matter. If the gap is more than 10%, then the modification is substantial. If the modification is substantial, then you apply extinguishment accounting, that is, you will derecognize the old loan and create the new loan. The new loan that you create will be based on the present value of the modified cash flows at the new EIR, because you are creating the new loan. And the difference, if any, will be shown as a loss or gain on extinguishment, as the case may be, which will be shown as a part of your profit and loss account. Now, once you recognize the gain or loss, after that the new liability will be recorded based on the new EIR. If there is modification accounting, that is, if the gap is less than 10%, there is no separate instruction which is given in the Ind AS. So, ICAI has given you two options, that is, you can either keep the carrying value constant. In such cases, you will adjust the EIR, or you can adjust the carrying value, in which case the EIR remains constant. Typically, adjusting the carrying value is more simpler from a student standpoint, and that can be done if nothing is given. In rare cases, along with extinguishment or modification accounting, you might also be given transaction cost. In such cases, you will consider the transaction cost as a part of the modified cash flows while calculating the difference. You will also consider the transaction cost as a part of the PV of the modified cash flows while calculating the new loan. So, you will first find the value of the liability considering all cash flows including the transaction cost, and once the transaction cost is paid, it will be reduced from the value of the liability. So, you will create the entire value of the liability including the transaction cost. Once it is paid, then it will be liability account debit, let us say to bank, because transaction cost will be reducing the liability. This is for modification accounting. Sometimes there may be a debt for equity swap arrangement, that is, you might have a loan liability, but if you are unable to repay it, then you might agree with the lender to give your own equity shares, in which case, to the extent the lender agrees, you will debit that part of the loan, credit equity share capital or securities premium to the extent of the fair value of the shares issued, and the balancing figure, if any, will be shown as a gain or loss on settlement of liability through the debt or equity swap. The remaining part of the loan, let us say there is a 90 rupees loan, 2/3 of it might be settled through issuing equity shares, but 1/3 might continue. So, the 1/3 part that continues, you will compare that with the present value of the modified cash flows, compare that with the present value of the original proportionate cash flows, and if the gap is more than 10%, then again you will apply extinguishment accounting. If the gap is less than 10%, then it is modification accounting. Okay, that takes care of derecognition. Then moving on to impairment. Well, impairment is for financial assets which have a contractual cash flows. So, items like investment in equity shares, mutual fund units, etc., where there are no contractually agreed cash flows, impairment provisions will not apply. Impairment applies when the present value of the contractual cash flows differs from the present value of the cash flows that you are expecting, probably because maybe you have bought a bond or you have given a loan. Now, the borrower is facing financial difficulty, the borrower will not be able to pay the loan as contractually agreed, in which case there is a potential impairment. Impairment is done for assets which are shown at amortized cost, or even assets which are at FVOCI, which are in the nature of debt investments. Sir, but if it is FVOCI, they're already at fair value. That is right, but the gain or loss is sitting inside other comprehensive income. If there's an impairment, the gain or loss will go to the profit and loss account to the extent of impairment. If the items are shown at FVTPL, to be honest, you don't need any impairment provisions, because impairment will show the asset, financial asset, at fair value, and the gain or loss, if any, will go to the profit and loss account, and hence there's no separate impairment provisions required. If you are recognizing impairment of a financial asset, the impairment loss will be going into the profit and loss account. A part of the impairment standard involves something called as expected credit loss, ECL provision. ECL says that you have to create a provision for the expected credit loss as and when you expect the loss to happen. You don't wait for the actual loss to happen. From initial recognition only, you will create a provision. Now, when will you create a provision and how will you create a provision? Well, you can create a provision from initial recognition based on various estimates, estimates that you can use, like probability of default, or you can look at historic data and predict the loss rates, or you can create a matrix like an aging schedule for debtors and try to estimate the loss. You will do that on an ongoing basis and not wait for the loss to actually happen. Now, how will you create these provisions? Well, the standard has divided the assets, financial assets, into 3 stages. Stage 1 is if there's no deterioration of credit risk, in which case you will look at the possibilities of default only in the next 12 months of the asset. If there's an increase in credit risk, like the amount that has to be paid remains overdue for a period beyond 30 days, or if the debtor faces financial difficulty, in which case there's an expected increase in the credit risk. If there's an increase in credit risk, you go into stage 2. Still there is no default. However, there is, let us say, an increase in credit risk, in which case you will have to look at the lifetime probability of default. So you not just look at the possibility of default in the next 12 months, you look at the possibility of lifetime default, in which case you will, in such cases, look at the lifetime possibility of default, and in such cases provision will be created based on the lifetime possibilities. And in stage 3, the debtor kind of says that I just cannot pay, he actually defaults, in which case there is an impairment. You will create a provision based on the lifetime probability of default, and now interest will be recognized only on the amount which is net of the provision. So this is for the expected credit loss model. The last 2 sections over here, one involves a special case, that is financial guarantee. Remember, financial guarantee is also a financial liability. We have put a separate video for the accounting for financial guarantee, as well as the one sum that has come in the institute's material. So you can refer that for a detailed guidance. However, financial guarantee is one of those items which is recorded as FVTPL. Financial guarantee is a financial liability. It may be contingent. However, because it is a financial liability, it is covered under Ind AS 109, which says that you will recognize the financial guarantee using FVTPL principles. Now, if you have to find a fair value, you will try to find the fair value as the present value of the commission that you can charge. That is, how much is the interest that is saved because of the guarantee given. To the extent the interest is saved, the present value of all of those interest savings discounted at the rate had there been no guarantee given, which is your real borrowing rate, that would give you the fair value of the guarantee commission you can charge. However, that is just a part of the guarantee, because, well, that is the guarantee commission you can charge, but you also have to consider the possibility that you might have to pay the money on default and you might not be able to recover the money. So you will try to find the loss allowance, and the guarantee fair value will be the higher of the present value of the interest savings, or the loss allowance, whichever is higher. Usually you will collect that money in the form of cash. However, if a guarantee is given by someone like a parent to its subsidiary, then it is treated as an indirect investment which is done by the parent in its subsidiary. As each year passes, you will try to find the fair value of the guarantee considering the present value of the remaining interest, or loss allowance based on the revised conditions, whichever is higher. You will keep on recording the guarantee based on FVTPL. So, for example, if there was a 70,000 value at initial recognition and at the end of the year it is 50,000, then the guarantee liability has to reduce. So, liability for the guarantee will be debited and credit will go to P&L because it is FVTPL. However, if the value goes from 70 to, let us say, 1 lakh, then the guarantee has to increase by 30,000 and the corresponding debit will go against the profit and loss. This will keep on going till the time the guarantee is ultimately discharged or settled, as the case may be. Last part of the standard involves something called as hedge accounting. Now, this is not something which has regularly come. This is not something which is very important, but nevertheless, there's a question which has come, I think, once or so in the MTP, so you can consider that. So when you're looking at hedge accounting, remember hedge accounting is optional. It is mandatory, not just for a student, but also in practice, because hedge accounting requires maintaining detailed records. You will have to designate a hedged item. You will have to designate a hedging instrument. So let us say you have investment in bonds, that is a hedged item. You might have taken a forward contract or an option contract, that is an hedging instrument. You have to show the economic relationship between the hedged item and the hedging instrument, maintain the detailed risk management policy, and if you are doing all of this, then you can take the benefit of hedge accounting. If you decide to take the benefit of hedge accounting, there are three types of hedges, that is the fair value hedge, the cash flow hedge, and the hedge of a net investment in a foreign operation. You will do the accounting considering the three types of hedges depending on the classification. A fair value hedge is a hedge to protect the fair value of the asset or liability, to protect the balance sheet value. The cash flow hedge is a hedge to protect the cash flow amount like interest or sales, etc. Whereas the hedge of a net investment in a foreign operation is a hedge taken to protect the net investment that you have done in, let us say, a foreign subsidiary or a foreign branch. Going to the fair value hedge, the general rule is the gain or loss on the hedged item, that is the underlying asset or liability, will go to the profit and loss. The gain or loss on the hedging instrument, if it is going to profit and loss, no problem, no adjustment to be done. But if it is going to, let us say, over here, some other item, then the question arises, where will you take? Should you take all gains to the P&L? Should you take all gains to the OCI? So in case of fair value hedge, the standard says that the gain or loss on the hedged item as well as the hedging instrument should be taken in the profit and loss. So the hedging instrument goes to the profit and loss if it is a derivative. If the hedged item is also going to the profit and loss, no problem. But if the hedged item is an FVOCI debt instrument and it was going in the fair value reserve, you will have to restate it and take it to the profit and loss account. Both gains and losses on the hedged item as well as the hedging instrument will go in the profit and loss account. The only exception to this rule is if the hedged item is an investment in equity shares which is shown under FVOCI, then the gain or loss on the hedged item, that is an investment in equity shares, will be a part of your OCI. The gain or loss on the hedging instrument, that is a derivative, will also go into the OCI in such cases. Last case, when we are looking at cash flow hedge, well, in case of cash flow hedge, you have a hedge to protect the cash flows, something like, let us say, the interest payments, in which case you will recognize the gain or loss on the hedging instrument, that is a derivative, in the P&L when the cash flow, that is the interest, goes to the P&L. So you might take an interest rate option for a loan that you are planning to take, let us say, 1 or 2 years later, in which case there may be a fair value gain or loss on that interest rate option today, but since the interest has not gone into the P&L, you will keep that gain or loss into something called as hedging reserve, which is a part of OCI. Once you take a loan and you pay interest, at that time the gain or loss on the derivative will also be transferred to the P&L, because this was done to hedge the interest. Interest is going to the P&L into the second year, then the gain or loss on the hedge should go into the P&L also in the corresponding year. That is a cash flow hedge. And last is a hedge of a net investment in a foreign operation, in which case you will account it in a manner which is similar to cash flow hedge. That is, the underlying gain or loss will continue to go in the FCTR, which is a part of OCI. And if there was a forward contract that you have taken to protect this, then the gain or loss will also on such item go into the OCI. Once you sell the foreign operation, the FCTR is transferred to the profit and loss account. The underlying derivative gain or loss will also be transferred to the profit and loss account. So this largely takes care of the financial instruments chapter. There is a small amendment that had come, though it is not really important from an exam standpoint. This is what you call as an IBOR amendment, where interbank offer rates internationally are getting replaced, in which case if you have taken a hedge and your rates are getting replaced, the standard says that the hedge is still considered to be effective even if the base is different. Not at all significant from an exam standpoint. Also, in this chapter there is a lot of content, and a student always is wondering that can I skip anything, should I just focus selectively? My honest answer is you should refer this chapter in its entirety. It is really important from exam as well as a practical life standpoint. However, if you have to kind of channelize your efforts and energy into specific areas of this chapter that will involve accounting for financial assets and financial liabilities. So the initial definitions, classification, you can kind of glance through. The theory part, institute does not ask you as much. However, the part that starts from accounting, like what is amortized cost, FVTPL, FEOCI, specifically items which are off market, like loans given to employees, to let us say parents to subsidiaries at different rates. This is institute favorite. Secondly, compound financial instruments, very, very important. And third is derivatives, not really embedded derivatives, but derivatives. So the core essence, if you open the past papers from May 2018 all the way up to May 2022, let us say, you will find more than 90%, without exaggeration, coming from these three sections only. It will largely be loans at off market rates, the accounting for them. There will be compound financial instruments, there will be derivatives. In certain questions, yes, you have questions on derecognition of financial liabilities, modification accounting, etc., sometimes impairment, but by and large this is your core area. I hope this video has been helpful to you. Please do like, share and subscribe if you think that the video helps. Let us know your views in the comments. If you have any other inputs or anything else where you want us to make videos or anything where you can improve, I would definitely be looking for your suggestions. Thank you very much, and this is Bhavik Chokshi signing off. Good luck, goodbye, and take care.